Hello, I'm John Ward on behalf of Physical Gold Fund and Anglo Far East, and we're delighted as always to have with us here Jim Rickards. Mr. Rickards is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for the Physical Gold Fund. He's the author of the New York Times bestseller Currency Wars, The Making of the Next Global Crisis. And most recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System, also a New York Times bestseller. Welcome, Jim, and thank you for joining us.
Thank you, John. Great to be with you.
Jim, we've been talking recently about your new book, The Death of Money. And today, I'd like to step back and explore a theme that's present both in this book and your previous book, Currency Wars. In both The Death of Money and Currency Wars, you point out that central bankers and finance ministers tend to use what you call equilibrium models to account for the economy. And you contrast these equilibrium models with what you referred to as complexity theory. Now, I realize that for some people, this terminology might seem extremely abstract and academic. But if I understand you right, we're actually talking here about a fundamental error that has enormous real-world consequences. So could you give us some guidance here? And first of all, what is an equilibrium model and what's wrong with this picture?
Sure, I'd be glad to, John. And the good news for listeners is that these concepts are actually not all that difficult. Sometimes the words are a little daunting, but I'd be happy to go through it very quickly. The Fed uses equilibrium models. So what is an equilibrium model? Well, a good example I think all listeners can relate to is an airplane. An airplane is made of tons of aluminum and steel and lots of other things. Certainly not lighter than air, and yet somehow it manages to fly through the air at high altitude. So how do they do that? Well, the answer is it's shaped and engineered in a certain way. So, the shape of the wing, it's flat on the bottom and curved on top. That means more air goes under the wing than on top of the wing because the curvature kind of blocks it. So that gives it lift. So how do you get the air moving under the wing? Well, you have engines. That gives it thrust. So you've got your thrust, you get your lift, you're up in the air, and now you want to turn because the air traffic controller says you need to go one place instead of another. How do you do that? Well, you have a rudder. So picture Janet Yellen in the cockpit with her hands on the controls. She can use flaps to change the shape of the wing. She can use a throttle to give it a little more or less thrust. And she can use her rudder to turn the plane to port or starboard or left or right, as the case may be. That's an equilibrium model. That's what she thinks she's doing. And so let's say you're flying a plane and there's a little bit of turbulence. And so the pilot says, we're going to go up a little bit higher to get above the turbulence to give the passengers a smooth flight. Or, the plane's losing altitude, give it a little more thrust, give it a little more lift, et cetera. So Janet Yellen's sitting there in the boardroom of the Federal Reserve in Washington, thinking of the economy as a plane that's not going quite fast enough and not flying quite high enough, and a little more thrust in the form of printing money, and maybe a little rudder in terms of forward guidance, and maybe a little lift in terms of quantitative easing or currency wars or other things, and this plane will do just fine. That's an equilibrium model. There's only one problem with it, which is the economy is not an equilibrium system. The economy is a complex system. And what is a complex system? Well, imagine the airplane suddenly turns into a butterfly. That's complexity. In other words, the unexpected, what's called technically the emergent property, the thing that you don't see coming. So here Janet Yellen's trying to fly this airplane using all the tools of monetary policy, and yet she's dealing with complexity. Now, just a word on complexity. And by the way, I do think this is the most important question in economics today, not just for monetary policy in the U.S. economy, but globally and actually for the entire economics profession. Because if economics and capital markets are not complex systems, then you can, skip the rest of this interview and don't waste time reading my books. But if they are complex systems, that means that every model of every central bank and every policymaker in the world is wrong. And therefore, it should come as no surprise that we keep having these crises and meltdowns. I'm not talking about the last couple of years. I'm going back to 1987 when the stock market fell 22% in a single day. That would be the equivalent of 4,000 Dow points from today's level. Imagine, if the stock market fell 400 Dow points, would be all that you would be reading about and hearing about. Well, imagine if it fell 4,000 points in a single day. Well, that's the equivalent of what happened in 1987. 1997, the Asian meltdown, 1998, the Russia long-term capital meltdown, 2000, the tech stock meltdown, 2007, the mortgage meltdown, 2008, outright financial panic. Why do these things keep happening? Was because the Fed's, sitting there in the cockpit trying to fly the plane, and it's not a plane. It's something much more complex. And another example of complexity would be a hurricane. We see hurricanes coming. We can spot them on satellites, but can you tell me exactly how they emerge, exactly when they're going to start, exactly where they're going to go, or how much damage they're going to do? No one knows that. We can guess or estimate, or we can say, gee, it's June, so we must be in hurricane season, or July from now until November. But in fact, no one can predict exactly where a hurricane will emerge. Well, that's an example of a complex system. So I go back to my original question. If capital markets and the economy is an equilibrium system, then Janet Yellen just needs to keep, giving a little more thrust and a little more lift. But if they're complex systems, she's using exactly the wrong tools, has exactly the wrong model. It's not surprising that the Fed fails time and time again. And it's important for the rest of us to understand complexity and see how it applies to economics. I think that's a much more fruitful endeavor.
Well, one consequence of the complexity you describe is that the whole system is vulnerable to malicious intervention, one of the themes in your new book. For example, intervention by what we might call financial terrorists. That's a pretty big topic, and maybe we can explore it in detail another day. But could you show us now how a relatively small attack on the markets could trigger a whole meltdown across the planet?
Sure. I would say that capital markets are vulnerable to malicious acts and financial warfare. I think we're actually in some danger of that today as the U.S. escalates sanctions against Russia. Russia is not a passive player, and they're not an immaterial player. They're capable of pushing back. In fact, Putin and others in the Russian leadership have already said they would. So there's some danger of causing a meltdown with this back and forth between Russia and the United States. But to your point, really about how can very, very small triggers cause a catastrophic meltdown or collapse. That is, by the way, completely characteristic of complexity theory and complex systems. By the way, it's not true of equilibrium systems. If a plane, go back to my analogy of the plane, it's not just an analogy. I mean, a plane is a good model of an equilibrium system. You might hit a little rough air and the passengers might get bounced around a little bit, but it doesn't mean that the plane falls out of the sky. That's an example of how small things actually don't impact equilibrium models that much. But in complexity, it's not true. The most catastrophic outcomes occur from very, very minute, not just minute, but actually impossible to perceive or measure changes based on initial conditions. So let me give you some concrete examples of that. And one of my favorites, and I've used before, but I think it will resonate, is an avalanche. So, you have a mountain, you have sort of an unstable pitch in the mountainside, and it's been snowing and snowing for days and weeks on end, and the snow has piled up. And now there's a very apparent avalanche danger. Experts can go out and look at that and see it's, leaning a certain way, but up to a certain height. It's windswept, and it's very, very potentially unstable, and it will collapse at some point. But it sits there for a while, and maybe the more daring want to ski underneath it because the view is nice. One day, a snowflake comes along. That snowflake hits this mountainside, disturbs a few other snowflakes. That starts a small chute that turns into a bigger slide. It gathers momentum. It brings other snowflakes with it. The whole thing creates force, and then the whole mountain becomes destabilized, and it comes crashing down, kills any skiers in its path, and buries the village below. Now, when we go back and sort of do a post-mortem on that, who do we blame? Do we blame the snowflake, or do we blame the unstable condition of the snow? Well, of course, you need to blame the unstable condition of the snow, because it may be, in fact, it is the case that a single snowflake started the avalanche, but it doesn't really matter. That avalanche was going to happen anyway. If it wasn't one snowflake, it could have been the one before or the one after. It's the instability of the mountainside that gives rise to this catastrophic collapse and the destruction that's in its path. Now, going back to the snowflake, however, we may not know which one it is. We may not know when it's coming. And I've just said that it actually doesn't matter, because if it's not one, it'll be the other. But in fact, it was a snowflake. There was a single snowflake that started the entire catastrophic collapse. I'll give you another very simple example. Let's say you're in a theater and you're listening to a presentation, and suddenly, let's say there are 100 people in the theater, so 100 people together. Suddenly, two people get up and run out of the room. what do you do? What does everyone else do? Well, odds are you do nothing. You might think that behavior is odd or rude, or maybe they got a text or they were late for something, but you're going to sit there and watch the rest of the show. But let's say of the 100 people that suddenly 50 people got up and ran out of the theater. What would you do? What would the others do? Well, I dare say you'd be right behind them because you would assume that those people knew something you didn't. Maybe the place was on fire. Maybe there was a bomb threat, but you certainly don't want to be the last to know. So in that example, what I'm trying to give an example of is what's called the critical threshold. The critical threshold is the point at which the behavior of others affects your behavior. If you're a stock market market's going down, you might say, well, gee, this is a good buying opportunity. It goes down more. And you say, well, gee, I see a lot of value here. And it goes down more. And you're losing a fortune, but you're still trying to hang in there mentally, believing all the propaganda coming out of Janet Yellen and the Fed. And then it goes down more. Well, at what point do you throw in the towel? At what point do you panic? At what point do you say, you know what, I'm getting out of here, I'm selling my stocks? That's an example of how massive changes in behavior can be provoked or catalyzed by very small initial conditions. So going back to my theater analogy, 2 people was not enough to get you to run out of the theater, but 50 people is. Your critical threshold in that example is, expressed mathematically is greater than 2, less than 50. Well, where is it? Is it 10? Is it 35? Is it 27, et cetera? Well, the answer is we don't know in advance. You may not know yourself. You may actually have to observe this behavior. Secondly, it's not a constant. It changes all the time. Some days you're feeling a little more bold. Some days you're feeling a little more cautious. So your threshold might go up or down based on how you feel that day. And then everyone's threshold is different. So at what point does everyone get up and run out of the theater? Well, the answer is it's impossible to know. Imagine, by the way, applying this example I just gave, not to 100 people in a theater, but to 100 million investors around the world transacting in capital markets and foreign exchange and commodities and stocks and bonds and derivatives every single day. You get some sense of the complexity of this. So the point is, we're talking about humans and capital markets, but I've compared it to, snowflakes in an avalanche. By the way, that's not just a cute metaphor. That's actually the math and the dynamics of this are identical. That's why we can use complexity theory and 60 years of good science, bring it over and port it to capital markets and get some very good insight. So the answer is that it doesn't take a lot. It just takes a snowflake. It just takes a few people changing their minds. That affects others. It builds, et cetera. And eventually everyone's running out of the theater. Everyone's panicking and markets are collapsing. But it happens very quickly, very suddenly, very unexpectedly, and people don't see it coming. But so what I study, since I've said, I'm not going to know what behavioral change causes it. I'm not going to know what snowflake causes the avalanche. What I study is the instability of the system as a whole. By getting a good grasp of the instability, you can predict the collapse even without seeing the snowflake.
Well, is there anything that could be done at the policy level? I mean, if policy minders shared this perspective, what might they do differently? What would be your prescription to secure the system against catastrophic failure?
Well, there's good news and bad news there, John. The good news is there's a lot that can be done. The bad news is policymakers do not share my perspective. They think they're flying a plane. They don't understand that they're in a rowboat in the tropics waiting for a hurricane that they don't see coming. So let's go back to what could be done. Well, again, and importantly, these are not just metaphors. This is actually good science applied in a new context where it should properly apply. What does the ski patrol at Aspen Mountain do when they see avalanche danger? Well, they go out early in the morning before the first skiers arrive. They climb a ridge line and they set off dynamite charges. They're actually blowing up the snow and causing it to go down harmlessly before it goes down spontaneously and kills the skiers. What does the United States Forest Service do when they see a massive danger of a forest fire? They'll actually start a fire themselves. It's called a controlled burn. Burn off some of the dead wood, the dry wood, so that a lightning bolt doesn't come along and set off an even larger conflagration that does a lot more damage. So people who actually deal with complex systems in the real world understand that occasionally you clear out the rot, you burn down some stuff intentionally, you set off avalanches intentionally in order to control the process and make sure it doesn't go out of control and do damage and kill people. Now, again, let's come over to capital markets. The technical word for this is scale. That is, when you have a large, forest that's all dry wood, or you have a large snowpack that's unstable, Those are scaling metrics. Well, in capital markets, we have scaling metrics as well. The gross notional size of derivatives, concentration of assets in the banking system, total assets of the five largest banks, et cetera. These are the scaling metrics. These are the financial equivalents of, unstable snowpacks and dry forests. So the forest rangers and ski patrol are descaling. So our regulators should descale. We should break up the big banks, break them into smaller units. That doesn't mean they can't fail. It just means that when they fail, it won't matter. Today, that's not true. Ban most derivatives. Again, that's the equivalent of setting off some dynamite in the snow. You make it go away before it does harm. So descaling the system by, maybe breaking up stock exchanges, breaking up banks, reducing derivatives exposure. And, the economics eggheads come out of the woodwork and say, oh, wait a second, we've got all these efficiencies and you're going to create inefficiencies. Don't you understand economies of scale, et cetera? Well, of course I do. I studied economics to the graduate level. I understand economies of scale, but those are often what are called first-order benefits. But policymakers ignore the second-order costs. In other words, they're very good at toting up the benefits of a big bank in terms of, typical economies of scale and global competitiveness, but they totally ignore the second-order costs from catastrophic collapses. That's because they don't comprehend the danger of catastrophic collapses because they don't understand complexity theory. So I would say that I would propose some things that actually, at a superficial level, are costly. They will cost, but they will save society in the long run. The long-term benefits of not having a collapse will outweigh the short-term costs of descaling the system. That's not a calculus that policymakers are really capable of doing because they don't understand the dynamics.
It seems that there's a connection between this theme of complexity and the theme of central planning, and you explore that quite a bit in your writings. Could you explain why a complex system like our economy is impossible to organize from the top down, and what happens when people try to do that?
That's a very good question. I debate my Austrian economist friends all the time. By the way, I'm a big fan of Austrian economics, and I've studied it, and I think it has a lot to offer. I don't count myself as an Austrian because I count myself as a complexity theorist. So I think it's maybe complexity theory is probably 21st century Austrian economics, if you can put it that way. I once scored some debating points with a very hard shell Austrian. He was going on and on about Menger and von Mises and that, and I said, well, that's fine, I agree. And by the way, if von Mises were alive today, he'd be a complexity theorist. But just to kind of get to the point of the question, Hayek's critique that central planning is impossible because no one mind is capable of possessing all of the information and processing capability to make smart decisions. It does apply in a complex system, but it also applies in a complicated system. And let me just spend a minute on the difference between complication and complexity, because they're probably synonyms if you look them up in a thesaurus, but in science they mean different things. Complicated is sort of like my watch. I have a nice Swiss watch, so if you take the back off my watch, you'll see gears and springs and jewels and various parts, and they interact in complicated ways. But an expert jeweler can go in, remove a particular gear, replace it, clean the rest, put the back on it, wind it up, and it works fine. That's complicated, but it's not complex. Complex requires interaction and adaptive behavior and what are called emergent properties, where something appears to come out of nothing. So now imagine you took the back off my watch and it was a metallic soup. And I said, I'd like you to go into that soup and change a gear. That's an example of complexity. In other words, the gears have turned into something that no one expected. That's complexity. Now, Hayek's critique applies to both. In other words, if the economy were only complicated, I say only in quotation marks, but I'm just contrasting it with complexity. If it were only complicated, Hayek would be exactly right. It would be there's too much information, too many moving parts, the watch is too big, it's too complicated for anyone, it's beyond the capability of any watchmaker, it's too big for any central planner, a committee of central planners or policymakers to run in an optimal way. So absolutely right about that. But coming forward into the 21st century and using complexity theory, I would say, well, gee, if it was too complicated to run, imagine if it's actually complex. It's certainly beyond the capability of any policymaker, not only because you don't have enough information, not only because you don't have enough processing power, although both of those things are true, but also because these systems are characterized by emergent properties where things come out of nowhere. Hurricanes just come out of the Eastern Atlantic Ocean and come and smash the state of Florida. And so while I agree completely with the Austrian critique that things are too complicated to manage and control, that's certainly right. I would raise it exponentially and say yes. And when you understand it's a complex system, it's even more impossible, and you shouldn't even try.
Well, how does the compulsion for central planning show up in the behavior of governments and central banks? And what effect is this attempt at central planning actually having?
Now we've moved from economics to psychology, but I'm game. And I like your word, John, the compulsion, because it does seem to be a behavioral impulse. There does seem to be something in human nature that compels some people to tell other people what to do. Maybe it's the bossy gene or the dictator gene or whatever it is. But I do think that there is an attraction of central planning that persists in human nature, notwithstanding the fact that it fails time and time again. And it fails and collapses, and then some new government or comes along, or just through the passage of time, people forget the lessons of history, as Santayana warned, and then we try it again. I mean, we have our new what I call friendly fascists, like former Mayor Bloomberg of New York, who felt compelled to tell us how large our sodas could be. Now, look, I've lived and worked in New York for decades, and on and off, and I like a lot of what Mayor Bloomberg did, and I think some of his civilizing initiatives, if you will, some of his efficiencies are good, but they can't stop there. They have to tell us how big our sodas can be, and that's it sounds like a trivial example, but maybe put in slightly more ominous terms. Show me a parasite that wants less. Every parasite wants more, and they keep taking more until the host animal dies. And that's really what we get to with this compulsion for central planning. And by the way, Bill Dudley, the president of the Federal Reserve Bank of New York, which is the most important regional reserve bank component of the Federal Reserve System, gave a speech recently in which he said, when you talk about their plans for monetary tightening. Of course, they're still printing money to the tune of $35 billion a month and with zero interest rates. So we're still in easing mode. But when they get around to tightening, whenever that may be, I may not live long enough, but we'll see. A lot of people expect the Fed to, first of all, unwind or reduce its balance sheet by, first of all, not buying more assets and then letting assets run off. And then after that, after some period of time, that they might perhaps raise rates. And Dudley was trying to sort of cut that conversation short and say, no, you should expect us to raise rates before we take steps to reduce our balance sheet. Well, that's a perfect example of this central planning compulsion, as you put it, and I think that's a very apt phrase, which is, I said, well, what parasite wants less? Well, what central banker wants a smaller balance sheet? What Federal Reserve Bank president doesn't want to control, $4 trillion of U.S. government securities. And by the way, when you manipulate the U.S. dollar market, U.S. interest rates, and the U.S. bond market, you indirectly, or even not so indirectly, manipulate every market in the world. It affects commodities, it affects gold, it affects the stock market, it affects employment. That's actually an explicit mandate of the Fed. We've turned the Fed into central planners that would make the Soviet Union blush. So I think the short answer is that there does seem to be some kind of behavioral compulsion. I'll leave it to psychologists to identify the specific cause, but we see it behaviorally. And again, if you understand the elite planners not as sort of people trying to get the best result, but rather as people trying to aggrandize power in the way a parasite sucks from the host, I don't see any prospect of that changing. And I think that, we're getting more and more parasites, and the host, i.e. the economy and capital markets, are in danger of dying.
Let's stay with the theme of markets for a moment, Jim. You make some stark statements in your new book about the condition of the financial markets today. You say that since 2008, markets have become a venue for wealth extraction rather than wealth creation. Could you explain that statement?
Sure. And it's a very important distinction because we're hearing a lot today, partly through the work of Thomas Piketty, the French economist, on the subject of income inequality and taxing the rich. We hear this in the White House, et cetera. And this debate is a bit sterile in the sense that it falls prey to what I call the tyranny of false dichotomies, which is that we tend to take certain public policy issues and break them into black, white, left, right, Democrat, Republican. We use these binary modes to understand them when in fact they're a lot more nuanced. Now let's just take the rich. Bill Gates is rich, and Jamie Dimon is rich. Jamie Dimon is not as rich as Bill Gates, but I dare say he's kind of wealthy beyond the dreams of everyday Americans. But Bill Gates actually earned his money. That is to say, yes, Bill Gates has enormous wealth, but he created enormous wealth. He came up with products that could be utilized in various ways, create goods and services, create efficiencies, make people more productive. He was a wealth generator. So, yes, he's got his 50 or $60 billion worth of net worth. But I look at Bill Gates and say, well done, because no doubt you've created multiple trillions of dollars of increased wealth all over the world, and you deserve what you made. Jamie Dimon, on the other hand, is a parasite. Jamie Dimon doesn't create wealth. He extracts it from the system, the same way you'd put a straw in someone else's milkshake and suck the milkshake dry. How does he do this? Well, he does it with government subsidies. I actually had occasion to debate my friend Maria Bartiromo on this. She's a big Jamie Dimon fan. And she says, look at all the billions of dollars that he's making for all his stockholders. And I say, Maria, think about it. He's got zero cost of funds, courtesy of the Fed. He's got underpriced FDIC insurance, courtesy of the FDIC. He's got an implicit guarantee of too big to fail, courtesy of the U.S. Treasury. And he's got unlimited leverage off balance sheet with his derivative books, courtesy of the Financial Accounting Standards Board. So he's being subsidized in every possible dimension. If you gave me, or actually if you gave my son's pet dog, free cost of funds, unlimited leverage, implicit guarantees and explicit guarantees, a well-trained pet could make $10 billion a year. Other things where Jamie Dimon is directly accountable, he's a massive failure. He's running a corrupt enterprise from top to bottom. He's cost his stockholders over $30 billion in fines, penalties, compliance costs, legal costs, et cetera, and they're not done yet. The regulators are not done with him. So the things that Jamie Dimon is responsible for, he's cost his stockholders $30 billion. The things that Jamie Dimon does not deserve credit for, which are basically government subsidies, he's making billions of dollars for the bank and taking very large bonuses. So Bill Gates is a wealth creator. Jamie Dimon is a wealth destroyer who extracts wealth for his own benefit from society. So that's the difference between a creator and a parasite. But they're both wealthy. And so the point is, let's not, I think it's sterile to say, rich versus poor, let's tax the wealthy. I think we have to ask, how did you get your wealth? Did you get it by creating more wealth around the world, or did you get it by, in effect, stealing or extracting wealth from society? If you're in the former category, I say bravo. And if you're in the latter category, I say we should shut you down.
I'd like to stay with this theme of wealth in a slightly different angle, also from your latest book. The Fed's money printing has had one consequence that makes many people happy, and that is that it helps maintain high stock prices. And the argument to support this is based on what's sometimes known as the wealth effect. Could you explain this phrase, the wealth effect, and also give us your assessment of the theory behind it?
Sure. The wealth effect is a very straightforward theory, which is that people have income and they have wealth. Income is, kind of what you make, and you pay your bills and pay your rent or pay your mortgage or whatever. And if you're lucky, you have a little bit left over and you put it into savings, et cetera. So that's your income. Think of it as your cash flow. Your wealth is basically your savings. So what your home equity, your stock portfolio, your 401k, your insurance policy, et cetera. So what the Fed wants to do is to increase spending. Actually, in a technical word for it is increase the velocity of money. There's no shortage of money in the economy. It's probably too much money. There's no shortage of liquidity in the economy. But there is rapidly declining velocity. Velocity is the turnover of money. So I'll give you a very simple example. Let's say I go out to dinner and I tip the waiter, and the waiter takes the tip money and takes a taxi cab home, and the taxi cab driver puts some gas in his car. Well, in that example, my dollar had velocity of 3. It supported $3 of goods and services, the tip, the taxi ride, and the gasoline. But let's say instead of going out to dinner, I stay home and watch USA soccer and don't spend any money. Well, then my money has velocity of 0. So the problem with low velocity is, you can have a $4 trillion Fed balance sheet, 4 trillion times zero is zero. In other words, if there's no velocity, there's no economy. So the real problem for the Fed is not printing money, which is easy to do, and they're very good at it. The problem is getting people to spend it, borrow it, use credit, et cetera, and get the velocity going. So they have to cause a behavioral shift. So the way they go about this, they're doing it several different ways, but to the point of the wealth effect, the idea is, well, if we pump up stock prices and we pump up housing prices, okay, you can't spend your stock certificates and you can't spend your house, but if you feel richer, if your net worth is going up, you might feel a little better. You might not want to stay home and watch soccer. You might go out to dinner and kind of start that velocity, lending and spending credit cycle going again. So the idea of the wealth effect is increase people's wealth. They'll feel better. They'll spend more. Velocity will go up and the economy will get moving. There are a couple of problems with this. And by the way, so that's the reason they've been pumping up the stock market and the housing market for the last 5 years. The problem is it's not working. Velocity continues to decline. We had a shocking first quarter GDP figure just come out. The United States GDP declined 2.9% in the first quarter of 2014. That's not just a bad quarter. That would be a disastrous result for a full year. And we had this in the first quarter. So clearly the wealth effect policy is not working. So the theory is exactly what I described. Pump up asset markets, make people feel more prosperous so they'll go out and spend money. The problem is it's not working. In fact, there's some reason to believe that the opposite is happening. In other words, as people earn and spend some and save some, and they watch this three-ring circus led by Janet Yellen of pumping up money, pumping up asset prices, creating bubbles, and trying to create the wealth effect, they may say to themselves, this is just another bubble. I got burned in 2000. I got burned again in 2008. My 401k is, a third of what it used to be, or maybe half of what it used to be. I'm not going to be a sucker again. I'm not going to fall for this. So I'll actually save more. The IMF has a name for this. They're called precautionary savings. It's what China does in their reserve position, by the way. So precautionary savings are savings over and above what you actually think you need. Just in case something bad happens, you'll have a little bit of a cushion. Think of it as a rainy day fund. So there's some evidence that by pumping up the stock market, everyday Americans are seeing this as a bubble, waiting for the next crash, and actually saving more on a precautionary basis. So far from having a wealth effect, it might actually be reducing velocity, and that's what the empirical evidence suggests, because velocity continues to decline. So the wealth effect is the theory. The idea is pump up these markets. The problem is it's not working, and the evidence is that it doesn't work at all. It's just a bad theory. But one more example of the Fed using the wrong models, and as I've said before, if you have the wrong model, you're going to get the wrong policy result every single time.
Given the fundamentals we've been discussing here, it seems that a fairly small event could trigger a pretty massive cascade through the system. We're back to the snowflake in the mountain. So I'd like to ask you, how close are we to a tipping point today?
Well, the technically correct answer is closer. And I'm not being glib when I say that every day we get a little bit closer. Now, I will try to kind of put a finer point on that. A lot of people think that the way this dynamic works is, everything's fine right now. Stock market's going up, housing market's going up, although that seems to be running out of steam. We had a bad first quarter, but maybe it'll be a little bit better in the second quarter. Unemployment's coming down. Of course, it's coming down for the wrong reasons, but you can cherry pick your data points and find a little bit of, kind of good news here and there, although I think in balance it's probably misleading. But the problem is people think it's all good, but then they think, maybe something bad will happen in the future, or maybe there'll be some mistake, or there'll be some policy blunder, and we'll get a bad result. And the point I'm making is that the mistakes have already been made. The snow has already piled up. The dry wood is already there. The blunders have been committed. We're just waiting for the catalyst. So it's not the case that a bunch of bad things could happen from here on out and then we'll get a collapse. It's the case that the bad things have already happened and we're waiting for that match or that snowflake to set the whole thing on a disastrous course. So I think that's important for investors to know, is that the blunders have already been made, the snow is already piled up, and the collapse is waiting to happen. Now, how close are we? Well, when I wrote my new book, The Death of Money, and I've said this in a lot of interviews and on my Twitter feed and elsewhere, that my horizon is kind of 3 to 5 years. I don't believe in 10-year forecasts. I think it's just too far a way to be very meaningful. But I've said we're not going to make it 5 years. There's no way. We'll probably won't make it 3 years. But I don't want to underestimate the ability of governments to paper things over. If the Fed runs out of steam, maybe the IMF will come along and start printing special drawing rights. And so don't underestimate the ability of governments to keep the game going. But lately, I mean, very recently, in recent weeks and even days, in terms of a lot of information I'm seeing, a lot of stuff is coming to light to suggest that if I'm wrong, it's because it will happen a lot sooner than I expected. This may even be something that happens late this year, early next year. And I don't want to put a stake in the ground and pick a date. That's nonsense. In fact, the proper application of the science I'm using would say that you cannot do that, so I'm not going to try. But given the scaling metrics, given the dynamics, given the things that we can know, that are knowable, I'm seeing a lot of indications that this collapse is coming sooner than later. And you actually, one of the best indicators is the extremely low volatility. If you look at various measures of volatility, not just the sort of the normal VIX I think investors are familiar with, but other sort of shock indices, if you want to call them that, and they're being produced by a lot of bank research departments. I don't go much for Wall Street recommendations, but some of the research is pretty good if you just use it for in a different way. What they show is extremely low volatility for 5 years, going back to 2009. Well, if you look at some of these sort of shock indices from 2009 to 2014, and you say, well, gee, what does that look like? Look at it over a 30-year period. Say, what does that look like? Well, it looks exactly like 2002 to 2007. In other words, the last time we had 5 years of this sort of average low volatility was the 5 years leading up to the catastrophic collapse in 2007, 2008. So I don't take any comfort from clear sailing. In fact, I consider it a warning sign that something very bad is right around the corner. And I saw one the other day that was striking. I put this on my Twitter feed. And by the way, if the listeners are interested, they can follow my Twitter feed at James G. Rickards. Rickards is Rickards, at James G. Rickards. It's an open feed, so you don't even need to sign up to Twitter to see it. It's just sort of out there, kind of like a web page. But I saw something. It was called the skew-VIX ratio, and it sounds a little geeky, but I can explain it very quickly. The skew is a ratio of out-of-the-money options to at-the-money options. Now, an out-of-the-money option is a bet that something dramatic is going to happen. You wouldn't buy an out-of-the-money option unless you thought there was going to be a big move because you'd be wasting your money. An at-the-money option is a bet that something little will happen because, you want to be, a small increase or a small decrease will enable you to make a profit on that. So the skew is out-of-the-money options divided by at-the-money options. So that's a measure of what the professionals think, what the options professionals think is going to happen. And what it says is that the skew is very high, which means that professionals are betting something big is going to happen soon. Now, take that a step further, take the numerator, which is itself a ratio, and reduce it to a single number and divide it by the VIX. The VIX is sort of, Joe Sixpack's volatility. VIX is what the market as a whole thinks is going on. So in my experience, options markets professionals tend to be the most savvy traders. They're not always right, but for people who really know what they're doing, the smart money, let's call it, they tend to trade in options markets because you can get a lot more leverage, a lot more bang for the buck, and you can do things that don't show up in the stock indices. And so to me, the skew ratio of out-of-the-money options to at-the-money options is what the pros are thinking. And they think something big is going to happen. The VIX is kind of a broader index, and again, I'll call that the Joe Sixpack Everyday American Index. That is quite low. So now divide the skew by the VIX and take that number and look at it over 30 years. That's an all-time high. It's actually worse than it was going into 2007, just ahead of the panic of 2008. So the smart money thinks something big is going to happen. The everyday money disagrees. The ratio, dividing that numerator by that denominator, is at an all-time high. So what I see is, once again, the everyday investor is being set up for massive losses, and the pros are getting out. By the way, not surprising behavior. Let's say you have a stock portfolio, and you think the stock market's a bubble and it's going to crash. Well, you don't necessarily want to sell your stocks because that could be a snowflake. That could start the whole thing tumbling down. You have to be careful about that. So what you do is you go over and buy deep out-of-the-money puts. Now when the avalanche comes, of course, you're getting slaughtered on your stock portfolio, but you're making a fortune on your out-of-the-money puts. So that's how the pros hedge their position without causing a snowflake to fall on the snowpack. So again, I'm just watching professional behavior versus everyday investors, and I see everyday investors once again are being set up to be fleeced. And these indices I'm talking about are coming thick and fast. So my view is that this collapse may come sooner than I expected when I wrote the book.
Well, Jim, very briefly, we wouldn't really complete this conversation if we didn't touch on the subject of gold, which is important to our listeners. So, given everything you've been telling us today, how does gold offer protection in the event of the kind of sudden and catastrophic disturbance in the system that you've been forecasting?
Well, we spent a large part of this interview, John, talking about complexity and complex dynamics and system scales and collapses and snowflakes and avalanches and all that. One of the things I like best about gold is that it's not complex. In other words, it's robust to all the collapse of complexity that we're talking about. Gold couldn't be simpler. It's it's an element in the periodic table of the elements. Its atomic number is 79. It's pure. You don't have to get into grades. I mean, yeah, you can have 14 karat gold, but we're talking about pure gold here, and we're talking about physical gold, by the way, not COMEX futures, not London Bullion Market Association unallocated forwards, not ETFs. I'm not talking about any of those things. I'm talking about physical gold, purchased on a non-leveraged basis in safe non-bank storage in your own care and control. So that's not complex. It's about the simplest thing you can think of. It's not digital, so you can't hack it. It's not electronic, so it doesn't go down when the power grid goes down. I'm not relying on an exchange for my ownership, so when the exchange collapses, I haven't lost anything. In other words, gold is the opposite of complex. Gold is simple and robust. And so when this catastrophic collapse of complex systems, which can include financial markets, but can also include other infrastructure elements, the power grid, internet backbone, et cetera, when it all comes tumbling down, your gold is still gold. And so one of the things I like best about it is that it's not complex. It's the anti-complex asset, and therefore one that investors should own to some extent in a complex world. By the way, John, maybe just mention briefly a good example of complexity on complexity or nested complexity or sequential collapses. And the best example I can think of, and these are all real world cases, so we don't have to be too abstract, was the Fukushima earthquake in March of 2011. Now, what happened there? Well, there was an underwater earthquake of massive magnitude. I believe it was 8.5, maybe even 9, but something almost off the charts. Now, the earthquake itself is an example of a complex system breaking down very suddenly, unexpectedly, in a place you don't expect it, in a way you can't foresee or predict. It just cracks. That's an earthquake. Well, the earthquake caused a tsunami. Well, tsunami is another example of a complex system, wave action. You can kind of understand at an abstract level. So first we have a complex breakdown in the earthquake. That causes a second complex breakdown in a tsunami. The tsunami then comes ashore and smashes into a nuclear power plant. What's a nuclear power plant? Well, it's got radioactive materials in it. Another complex system where you use fuel rods and neutron generators to dial up or dial down the degree of radioactivity, to boil water, to generate steam, to power electricity, etc. And when the Fukushima plant began to give off radioactivity and other disastrous things happened, what happened next? Tokyo stock market crashed. And as I've explained in this interview, capital markets are an example of complex systems. So here we had 4 complex systems interacting sequentially. Tectonic dynamics in the earthquake, wave dynamics in the tsunami, nuclear dynamics in the power plant, and then financial dynamics in the Tokyo Stock Exchange. And each disaster led to the other. So complexity is daunting enough when you apply it to a single phenomenon such as nuclear power or stock markets. But imagine these sequential collapses. This is the world we live in.
Well, thank you, Jim Rickards. This has been extraordinarily illuminating, and it's been great having you with us today. And thank you to our listeners. As Jim mentioned, you can follow him on Twitter. The handle again is @JamesG.Rickards. And speaking of Twitter, once again, I'd like to encourage you to share your questions for our next podcast. In particular, in fact, next time we're hoping to garner several questions from you as in the Twitter feed. So use the hashtag Ask Jim Rickards, followed by your question. And wherever you post that on Twitter, we'll find your question. We'd love to hear from you. And just a reminder, you can find Jim's new book, The Death of Money, at Amazon or any good bookstore, and do get yourself a copy. So goodbye, Jim, for now. Thank you.
Thank you, John.
And goodbye to our listeners. We look forward to joining you again soon.